Right, so we're looking at a couple of things today. So first of all, for those that didn't come to a group therapy before, we kind of opened this one up to whoever wanted to come. For those who didn't come to a group therapy before, this is my chance personally to have a more relaxing, interactive session with people. So it's not really a scripted webinar. It's just we'd like to be interactive and cover some nice topics where we can have a two-way conversation. What we're going to do today is we're going to look at two things. We're going to look at one of the final things that you need to do, or that you can do rather, to make the most from a particular setup. So we'll do a recap of the process or the process that we've defined at Jigsaw of implementing a setup. And then we'll look at the last step. And after that, we're going to look at some of the order flow right now live and talk about how you can handle the volatility. Now, are any of you here new to order flow? Can you give me a why if you're new to order flow, please? Okay. Carl, you're not new. Right, somebody claiming to be new that isn't right. So one of the things you've got to realize right now, it is a really tough time to be learning order flow. But what we're going to do is we're going to give you some techniques and some things to look at where you can actually start to learn instead of just like being like in awe of this crazy volatility we've got. Anyway, disclaimer, basically this says don't trade. I'm going to talk about trading here. I do talk about it from my perspective, which means my own tolerance for risk. Your tolerance for risk is naturally going to be different from mine. So just bear that in mind as we go forward. So the process, this is a process that we're going to talk about. We did a few sessions a few months ago called Trading 1, 2, 3. I also do some occasionally do some one-on-one mentorships. I've got about 15 students, I think, right now under mentorship. And it's not something I do a lot of, not something I want to do a lot of, to be honest. But it's been really, really interesting to me. It's been a good learning experience. And this is the process that we take people through. So the first part is we find a setup, and that's quite easy. Most people have started the mentorship with a setup that they've brought to the table. Some people bought more than one setup, and some people, very few people, got told their setup was probably nothing we should focus on. And so when people start trading, the presumption is the setup is the most important aspect of trading. And it really isn't. It really isn't the most important part. The problem with any setup is that it will stop working. And so there's a process involved in actually, first of all, seeing if the setup's got value, and then, then going into sim, and then going through that change of market state. So what we do is we find a setup, and then we take a couple of weeks in real time, usually for 2 hours a day, to see that setup in motion. Now, obviously, if it's going to be 2 hours a day, that means a couple of things. First of all, it means we need a setup that's got enough frequency where it's going to occur each day. So at Jigsaw, we kind of say we want people to trade frequently, which is what prop firms do. So there needs to be a setup that gives you setups every day, and a kind of an extremes with the people I'm working with. At extremes, 10 to 15 setups a day, low end, 2 or 3 setups a day. But for all the students, there's a cutoff of 2 hours. It's basically 2 hours for most people. There are a couple of exceptions to that, just based on their kind of individual skills and their ability to focus, where they have started off with a slightly more time at the market. But for most people, if you've got a full-time job, spending more than 2 hours a time trading is really, really tough. So Phil's 8 to 12 trades a day. But Phil, for us, that's in a 2 hour period we're looking. And so extremes are 10 to 15 setups in those 2 hours, right? So a lot of people have got full-time jobs. Working with people on the West Coast, for instance, who they start like 6:30 in the morning, which is when the US opens, and they've got that time. It's quite a good place to be actually. They've got that time before the open. Work with some people in Europe who are trading, before or after work. And 2 hours is a good amount of time. It's a good amount of time. It's good to be at the screen the same time every day. You get that consistency. You get to know that time of day. You get to know that setup, and you watch the setup for 2 weeks, and you make this assessment in real time. Is it any good? It's all you want to know. Does it work? If I'm looking at, Ichimoku clouds or whatever, some of the kind of more way out there things in trading, it only takes you 2 weeks of actually watching the setup every day to find out if it actually works, right? If it was giving you one trader every 3 days, then 2 weeks isn't enough. But if your frequency is 5 or 6 trades in 2 hours and you're getting the setups and it's just a complete wash, there's no edge in it, you'll know in 2 weeks, right? Now, what most people are going to do with a setup, most retail traders do, is they find a setup, they sim trade it, and it could work for a while. But then when the market changes, it stops working. But the problem is when they're sim trading it, they don't actually know the potential of the setup. They only know the outcome of their sim trading. So part of step 2 also is to find out the potential. So after a few weeks, what you've got a list of every setup that occurred in that 2 weeks. For the winners, how far did they go against you? So you can start to figure out what your stop should be. How far the market actually went. And then on the losers, at what point did you know they're losers? So you start to build this picture and build this confidence that, wow, this actually works or it doesn't work. And sometimes people will say, Pete, I saw this trade, but I was looking for this trade, but I saw a slightly different trade. And that's fine as well. The next part is you get onto the sim. And of course, that's when you realize that, that setup that you found that's yielding 20 ticks a trade, you're sim trading, you're getting shaken out. You're getting shaken out of the trade. You let them go. It's going a couple of ticks your way, coming back, you're exiting, and then it's going the 20 ticks. And that's when you start to see the mistakes come in, the obvious mistakes. And then you have to basically iron those mistakes out to get, the kind of stats from sim close to what you get in from the real-time analysis. And now while you're doing the sim trading, you're still actually maintaining the records of what the setup can achieve at its maximum, right? So it's like the maximum potential for the setup and then sim trading the setup are going to be two different things. And we're trying to bring them in line. And that's the process we go through until such a point. And this point has never failed to happen. So Ryan's saying he watches old recordings from the market, finds his setups and write them down. That's a really good idea especially if you've got old recordings. Phil, I often get out too early on most momentum trades. Big problem getting out too early. Now, Phil, we're going to look at something today that's going to help you with that. It's not this process, though. I know you go into sim and you're trying to get your sim close to real time. And then without exception, for every trader, the market state will change, right? It will become more or less volatile. And the kind of rigid rules you've set that you're trading on sim, you'll start to see the results go down. You'll start to get stopped out more often. It will start to fail. Now, that's the point at which your typical retail trader who just finds a setup and trades it, he will think it stopped working. He will think it doesn't work. He will think it's no good. He will move on to the next thing. And effectively, it's that cycle that keeps people changing technique over and over and over again. Because basically, when the market state changes, they don't really notice that it's changed and they don't realize that it's just an adjustment process. So this is what happens over time. We move on in time and volatility just goes up or down, right? It's something we see. Something if you're looking at the market today, obviously it's very obvious, but as we go over, through the months, go forward, that shift in volatility can be quite subtle. So this year, as we went into the summertime, it was quite a drag. We didn't, we usually have like a short, slow period at the summertime, and it was quite a drag. It kind of like slowed down gradually into it. And, we had that summertime. It was a little bit of a painful summertime. And then when we came out of that, it went back to normal and everything would return. So we have to find strategies to tell if the market has changed state and then what to do if the market's changed state. So you could move to a market that has the volatility you're looking for. You could make some adjustments to the way you trade it. If it's become more volatile, you can get in a little bit after the event instead of getting in when you get your trigger. We'll look at that again in a second. But basically, you've got to understand that this is a natural process that occurs all the time, and it will affect your trading, and your trading has to react to it. And it's not that difficult to react to it. It's just really difficult if you don't know about it, right? And as I say, all of the people that are working with me as they're doing this sim, they're still keeping these spreadsheets that they created to assess in real time. So they actually are collecting data through these periods of what happens when this shift takes place. Now, so this is stuff we already talked about. We already talked about this in the group therapy. We talked about it in the training 1, 2, 3. So what happens next? So let's say you have got a handle on shifting the volatility. Let's say you trade gold and crude, for instance, and you're trading volume spikes on gold and crude. When the markets become more volatile, you focus on gold. When they become less volatile, you focus on crude because gold is a bit slower than crude, right? It's just those simple changes that aren't really that terribly difficult. But there's a whole bunch of other problems that traders have. Phil's saying he gets out too early on most momentum trades. So the kind of key problems that people have, one is leaving money on the table. 2 is not taking setups. 3 is getting shaken out of good trades. And number 4 is not increasing size on better quality setups, right? Now, so today what we're looking at is how to kind of push your advantage. So when you've got a setup, that setup is giving you an advantage. Now, it might not be giving you any more than a 50% risk reward. So one of the traders I talked to today, I think it was over about a 20-day period of sim trading, he made 350 ticks over a 20-day period of sim trading, which is really good. But he thought his results weren't very good because his win rate was 49%. He might even be in here. And that's a mistake to have that kind of thinking. As long as your setup has got an edge, in other words, it's either you could be winning more than you're losing, or you could be making more money when you win. You've got an edge. Now, how do you maximize that edge? Right? What's the next step? It's not going to be a spreadsheet this time. So the next step is also related to why we start off at 2 hours, because the next step is going to add 30 to 45 minutes onto each trading day potentially, and which obviously if we're looking at 4 hours, it's going to add a lot more. So the next step is basically you have to be able to watch yourself trade, right? So what we do is we video the whole session, okay? And then you have to, again, we had Brett Steenbarger on a few weeks ago. I'm not sure if you saw him, but he was talking about this as well, is you have to try and figure out what your biggest problem is, right? So for a lot of people right now, it's they're leaving money on the table, right? They've got no problem stopping out. I don't actually have a single student that lets his winners run. I don't have a single student that misses their stops. Everybody understands the value of having a stop loss, and they've worked out where the stop loss should be. And nobody seems to have a problem with that. But what they do is the market goes 3 ticks and starts to fall back, and they get out and they have a 2-tick winner on a move that was 30 ticks. So one of the big problems is leaving money on the table, right? So let's say your problem is leaving money on the table. When you finish a session, you get up, you leave the screen, you go and have a coffee, have a run, whatever, just clear your head, right? Disassociate yourself completely from the person that was just sitting down trading, right? So you shouldn't just stop trading and then watch the video, because you're still in that you're still that same person. You're still in that frame of mind, right? You still haven't had like a bit of a clear your head. So it's important to get up and walk away from the screen and just do something. If you live in a countryside, just go for a walk, right? When you've done that and you've cleared your head, come and sit down and watch the videos of yourself trading with your mind on whatever it is you think you're doing wrong, right? Ryan is also watching his recordings in the evening when he's relaxed, usually with the beer or scotch. The beer or scotch, Ryan, is a really bad idea. Okay, so it's worth talking about this, right? Because one of the things about trading that is a little bit it's a little bit out there. It's kind of a bit I shouldn't use the word vegetarian, that's the wrong word. It's a bit of like I think some things are a little bit Californian, a bit hippie-ish, right? A bit out there, a bit spiritual. But you do not learn while you're studying, right? You will not learn while you're watching the videos, or you will not learn as much while you're watching the videos, right? So if you ride a bicycle, you know this, you do not consciously attempt to balance riding a bicycle, right? If you're driving a car, you do not consciously drive a car, right? When you were driving a car, there was never a single driving lesson you took where you improved in the lesson, right? It's very rare to be having a lesson and actually improve during the lesson, right? But what happens is you go away and your brain processes that, and your brain processes, sorry, Jeff's from California. Jeff, I've spent about a year in California. You know what it's like as well. Right, so you don't learn while you're doing the thing, right? Yeah, I'm just kidding, Jeff, as well. You don't learn while you're doing the thing, right? You learn, you learn afterwards. So I can tell you as somebody who's like, I've got a big technical background, a big background in solving problems. Quite often, if I couldn't solve a problem, I would just forget about it and go to sleep. And in the morning when I woke up, the problem would be solved. The solution for the problem would be in my head. So you can't think that all of the thinking and all of the smarts that you do is the conscious bit. There's a big bit of your brain. A lot of what we learn is subconscious, which is why, Ryan, if you drink alcohol while you're watching the videos, that part of your mind is actually going to be off. So it's true. So you're not going to learn, you're not going to let this, you're not going to absorb this in the same way if you're under the influence, even if it's just a drink, right? Just a single drink. So, but basically what you're going to do is you're going to watch the videos, and a lot of the time you're going to watch the videos and you're going to think, who is that chump trading like that? You're going to watch that person trade and you're going to think, oh, what a fool. A lot of the time, you're gonna be watching that person trade, and you're gonna be like, well, I'm getting out early, but I can't really see what I'm doing wrong. And then you do that the first day, and the second day, and the third day, and over time, you're actually gonna get it. It's actually gonna come to you. You've got to focus on that particular thing and review it, and try and think and try and challenge yourself. Well, what am I doing wrong? And eventually, you'll find, just like everything else you've done that was difficult when you started it, the answer is going to come to you. You're going to start to see what you're doing wrong. A lot of the time, it might just be, God, if you just let it run, if you just kept a finger off the button, you'd be fine. And it's the same for missing setups, the same for getting shaken out of good trades. It's all about just saying, okay, what am I doing wrong? And just watching it and just watch yourself doing it over and over again. And you'll start to see the patterns. But this is a painful thing to do. There's no doubt about this. Watching yourself do stupid things, or things that you consider to be stupid, over and over again is a bit painful. And the things that you're doing now, they're not stupid. They're just things that you're doing. Now, what I can tell you is if you get to this step, right, if we go back to the 4 steps, right, and I've talked to all of the people that I've taken through this process. So finding a setup, assessing it in real time, going through it on simulator, handling the market state changes. By the time you've got to that point, you're ahead of about 95% of anybody who's ever attempted to trade. You're literally 95% ahead of all retail traders, right? Because most people, all they do is they find a setup and they try and implement it and they give up. When they find another one, it gets a bit difficult. Grass is greener on the other side, right? So when you get to this point, you're already ahead of everybody, and you're really looking at the icing on the cake at this point. Now, some questions about this. A given strategy works for 2 weeks but doesn't for 4 months. Then works for 1 week, then stops for a month, rinse and repeat. That's pretty rare, but if you've got that, then that's kind of tough. But there are things that do need extreme volatility. But for most of the stuff that people were looking at, things like leaning on icebergs, leaning on absorption, on the like treasuries and stuff like that, on the side of the overall trend, that's not the case. You know, there usually is some kind of adjustment you can make. For the videos, Gabriel was asking, what is a must for recording for the videos to be useful? I would say silent videos, just a recording of the things that you use to make a decision. I know most people are recording one screen. I've got a few people that are recording 2 screens. Phil saying, it felt like this morning when I had his only lesson session, he's just like, who the hell made that trade? That's another thing that you're going to see as you go through this process, right? There's this feeling you get when you're trading and you get to the end of a session and you have a particular feeling, positive or negative, about how you performed in that session, right? That in itself will change when you watch the video. So there will be sessions when you feel you didn't do very well. And when you watch the videos, you'll actually see that you did okay. You might have been fighting all the way through, but you see that you actually did okay. And the opposite is also true. There will be sessions where you feel you traded like a king, but you look back at the videos and you see you just left a ton of money on the table. So another good part of this process is that it really puts that session into perspective, good or bad, which is a feeling you don't really get in the moment. I mean, I've even had people, I talk to them and I say, how was your week? And they say, it was a terrible week. And we go over the stats and it's like, well, you had a 70% win rate. I mean, what was terrible about it? You made money at 70% win rate. It's just at the time, it didn't feel good. Now, somebody's asking, are these screen recordings of your whole day? Then watch them at 2 to 4 times speed at night. Norseman, this is a screen recording of all the time you spent trading. We recommend 2 hours trading a day, and you only watch the trades. So you watch from just before the point you got in. It really helps if you actually write down the times you trades. But again, as you've seen in the steps that we have people working on, they're writing down, they're making note of every trade anyway. But if you write down the actual number of minutes in on the video recorders usually show you where you are when you're recording. Just go over the trades. You want to actually see how you manage the trades. You're not really interested in the bit in between. Mark's a trading site coach. He suggests to his clients to immediately review and write down as much as they can about the thoughts and feelings they experienced during the trade. Because the heart of 90% trading mistakes are psychological. Good, very good point, Mark. James, I've been appreciating the value of focus. I used to try to trade several instruments at one time, but found couldn't really do one of them justice. I'm doing much better with trading only one instrument. And that's very true. If you can't make money with one, you're not going to make money with 20, right? Very true. So basically, we're looking for mistakes and we're trying to focus on the next mistake in line, the one we think is the most important, and we're just trying to iron out that wrinkle. And the only point of ironing out that wrinkle is to make more money, right? So if you're not happy, I don't know, if you're making a mistake or something you're not happy about, but it's not affecting your bottom line, personally, I wouldn't care about it. Now, the other focus area is increasing size on better quality setups, right? Now, so you might have a setup, for instance, one of the ones I'm talking about today was a retracement to a step on the volume profile in a trending market. And it's kind of very common one that we do. We talk about a jigsaw. So you get a short-term range, the market breaks out, comes back to the top of the range. Now, if you're trading, that's one setup, right? That's one setup that will occur over and over again, right? But some of them will be better than others. I mean, how many of you here feel that within a single setup, sometimes you just got that gut feeling that this is a really good one? Have any of you felt that? Absolutely. Now, for the people who did feel that, can you always quantify why? Can you always say, can you always put your finger on exactly why it's a better setup? Or is there some, yeah, no. Okay, it's a feeling. But again, it's familiar. I mean, with the retracement to a high volume node, it might just be the steps more pronounced. It's spent more time there, but there's just something that you remember. There's just something in your memory, your subconscious that's doing a lot of this processing, that's recognizing a certain pattern. Something because you've watched it so many times, and you're so used to seeing it. Okay, right there. Hello. Right, can you hear me okay now? Okay, I'm back. That's weird. Right, so there's just a feeling, but it's not just a feeling, right? It's like when you're driving, right, and you're changing gears and you just keep yourself on the road. It's the subconscious mind. It's the bit of you that's doing most of the work, that's not at the front, like telling you what to do. It's not that bit of the front that where you talk to yourself. You don't say, I am now going to change gears. I am now going to move the steering wheel slightly to right to avoid that bump. It's just automatic. And like I say, it sounds a bit airy-fairy. It sounds a bit spiritual. But at the end of the day, that is the way we work. And there's no, whatever evidence you need to kind of to prove to yourself that that is the way that we work. Play tennis, right? When you hit the tennis ball, you're not thinking about where to put the bat. You're not thinking about where the ball's going to go. It's just automatic. So you've got that part of you that's automatic. You have to lean on that, because one of the things that a lot of people expect, and John Grady talks about this, did a webinar with us recently, you expect your profits to be linear. That, you expect each month you're going to make X amount and each day you're going to make X amount. But your profits aren't linear, and some opportunities are better than others. So as well as these focus areas of making sure that you're focused on really just taking a good look at your bad behaviors, you also need to focus on, or just listen to, that inner voice that's telling you, this is a really good one. Because on those trades, you need to trade different size, right? And it is a little bit of a difficult thing to do. It's a little bit, and you don't have to go, all in, but it's something that, because you've got that inner voice telling you that this is actually a better setup, you can't really afford to not take advantage of that, right? So for leaving money on the table, you cannot afford not to take advantage of that. For missing setups, if you're missing good setups, you cannot afford as a trader to let those setups go. For getting shaken out of good trades, you cannot afford as a trader to let that happen. This is all stuff. This is all profit. This is all steak or sandwich, right? This is what's going to make a big difference. And this is to increasing the size on better quality setups. And, I even tell people, for any setup, I don't do this at first. So when I start with somebody, I'm just telling them, so you just look at the setup, how many times it happened. And then when they're sim trade, I'm just like, let's sim trade and see if we can get to profit. And then after that, we then start looking at these things. And after that, we then start looking at, okay, do any of these opportunities seem better to you? You don't want to try and do all these things at once, right? If you try and bring all these things in at once, it's just too much, right? You can't, it's just impossible to do. Phil's usually too afraid to add to most positions, and I feel like it will whip back on me and give me loss on more contract. Well, that's kind of fear, Phil. You've got a fear problem. You've got an issue with that. And now, one of the things to do, Phil, what I do with somebody like you, is I would say, I want you to rate, as you're creating this spreadsheet of all the opportunities, I'd say I want you to rate each opportunity at the time, A, B, C, D, E. And you rate them and don't do anything about it. And we'll just see if the A opportunities are actually better. And then when you've got that information in front of you that the A opportunities are better or not, then you can decide whether to react to it. But one of the big problems with what you've got, Phil, partly it's fear. And for a lot of people, fear is a factor. But I think the big issue is lack of knowledge. If you don't really know if that decision is actually going to make you more money or just lose you more money. So your fear level's rising, partly because you haven't got the information to know that it's a good decision, right? And that's why we kind of go through this process. Yeah, Lewis, you've got issues with this. I'm able to see the setups, but I'm failing to fire. What you have to do is when you're doing your video, you're going to have to write in your notes all the setups that you see but don't take, and you're going to have to go back to the video and watch them and watch yourself not take those setups. And also understand the impact. So with the people I work with, everybody's got a spreadsheet that's got every single setup that occurred. And if they didn't take it, they can see the impact of that. So it's partly that's a knowledge issue, and it's just something you have to iron out. Okay. So that's kind of the process part. Video every trade. And obviously you don't create individual trade videos. Watch after you finish trading, after a break. It can be painful. It can be positive, right? Positive usually because people think they did badly when they did quite well. Initially, you will feel like you're watching someone else. You'll feel like you've got a slightly less intelligent twin that's been doing all the trading. Right. So that's kind of it on the video. It's not a very difficult thing to do. The keys really are to take a break and then just go through it and just understand that you've got to focus on, there has to be a focus. You can't just say, I'm going to watch this and improve everything, right? If you're a golfer and you're slicing the ball, your coach would work with you on that for a while. If you're, so don't think you can just improve everywhere all at once. And that's what a lot of traders do. They just go all in. It's a big mess of one thing called trading that they try and improve just by clicking buy and sell. Gabriel was saying, you've mentioned one point, you're recommending 2 hours of trading per day. Gabriel, if you're in a prop firm, I'd recommend more. If you're retired, I would recommend 2 hours a day and enjoy your retirement. I don't really see the point of doing a lot more, to be honest. I really don't. I mean, even you sit in a prop firm, it's kind of rare to see them just, trading in and out for 8 hours straight. They are quite a lot of the time, screwing up balls of paper and throwing them at each other across the office, waiting for a news announcement, a news release, stuff like that. So, there are times when they will trade a lot more, but I really don't think, if there's a lot of people with full-time jobs, absolutely 2 hours would be the max. But if you can find an opportunity that occurs for 2 hours, I mean, if you think about it, in the US morning, most of the opportunities are in the first few hours anyway. Of course, granted, this year, it's been slightly different in that, we've had a lot of days this year where we've opened slow, and then afterwards the market sped up, and the opportunities come like at 11 o'clock in the morning Eastern time, which is kind of weird. But I'm not sure why you'd want to do more than 2 hours. You could do 2 hours in the morning, 2 hours in the afternoon, but I'm not sure you would get anywhere that much faster by cramming. So Kevin's saying, when I trade a few hours in the morning of the ES, look back later and see much more of the structure having developed and the read a bit easier. You're saying, does it make sense to vary the times you can? No, it doesn't make sense to vary the times you can, but it does make sense to choose the best time. So if you're finding, and maybe you don't base it on actual physical time, maybe you base it on when that structure's available. So you come back every 10 minutes, and when you've got what you need to see, then you can start trading. But I would say for most people, it makes sense to stick to the same times of day, because when the market opens, certain things happen. So if you were trading the open every day, like me, I very rarely watch the close. And, I think the first time I really saw you watch the close, I was actually in Chicago. And I was just like, mate, what's going on? It's just sticking at one price and trading 50,000 contracts. And I'm like, has it gone limit down? I said, no, it's just the close. I'm like, wow, that's so weird. And so you wouldn't want to go from trading the open to trading the close. Now, one of the things we said, right, over time, volatility changes. and you've got to understand the shifting states. But what's happening right now is not this, right? That is not this, right? So I said the volatility is going to change and affect your setups, right? So what I'm talking about when I say the volatility is going to change, I'm talking about this stuff here. So this is the VIX. If you don't need to know the VIX, it's the volatility index. It's based on options prices, but it is very closely related to the volatility in the US indices, right? So you can see this up, down, up, down, up, down, up, down. You can see the kind of shifts it's putting in. And that's kind of the normal. We're in that kind of range. Those are the kind of changes that you see over time. And you can see, the kind of time periods we stay in a particular range. And then, we've got this little peak here. And you can get a feel for, every, 3-4 weeks, we get some kind of change in volatility. And it's a gradual shift. I mean, this shift here wasn't so gradual, but quite often it's a gradual shift, right? This is now, right? This is where we are now. Okay, this is the 1st of October. This is exceptional. This is not the market changing gears, right? This is a panic, right? Now, if we say it's exceptional, it's that exceptional. We're at levels now on the VIX we haven't been to for 3 years. So as somebody who watches the markets every day, I can tell you this is exceptional. So when I see this market, this activity, I'm just like, well, whatever. And I can just stop trading. I've got no real incentive to trade this level of volatility because I know it's so rare. There's really no point in trying to learn to trade it. There's no point in trying to make your setups work on it. But if you are halfway through the learning process, it is kind of tricky to just stop. And it is very difficult to just stop. Also, if you just started, you don't want to start by stopping, right? So what we have now is exception, makes the markets very slippery. There is a lot of opportunity, but there is also a lot of risk. Now, in terms of the prop traders, I know prop traders that love volatility and they're not really enjoying this, right? So I know I've talked to a few managers in prop firms. They have had, they've had traders that had some pretty big drawdowns that have been quite upset, crying on the manager's shoulder, all that kind of thing. So this is exceptional. This kind of thing doesn't happen very often. It is a knee-jerk. It doesn't matter what you hear about the reasons for this. The trade war in China. I mean, the funny one is interest rates. Interest rates have gone up. Interest rates are so low now. Interest rates could be 3 or 4 times higher and the US indices could be completely stable. So this isn't some kind of relationship between interest rates and volatility. It's a knee-jerk, right? And the problem with a knee-jerk like this, James Rice, I did see a spreadsheet. We'll take it offline and do that on a one-on-one. One of the things about periods like this is the HFTs, algorithms, market makers, call them what you will, they're very, very short-term traders and they provide liquidity in the markets. It's been very typical. We talked about this in webinars before. When the VIX, it used to be around 23, 24. When the VIX goes over 23, 24, they all get out of the market. They all disappear, right? So what's happening now, we've had this big shift in volatility. We've had this kind of big shift. The interest rates went up. Market went into panic. The market makers, HFTs, that we all think are evil, what they do is they actually provide liquidity and keep the markets a lot more stable. And so what we're seeing now is those guys not engaging in the market. So they've been turned off. It's too risky. And of course, that's kind of a self-fulfilling prophecy, obviously, because they're turned off, it's staying very volatile. So yesterday, we did over 100 points on the S&P, right? You can make money this way, but it's not worth making. Mandeep's profitable in this. Scalping around, trading naked. You can make money in this market, but there's no point making this your main trading technique, right? There's absolutely no point really in learning to trade the S&P 500 at this level of volatility, because there's a good chance it won't happen again for another 3 years, right? So yes, shifts in volatility occur. This shift is exceptional. There is absolutely no reason to think this is a long-term change. It is a knee-jerk reaction. People like CNBC, Bloomberg are always going to assign a cause to that reaction after the event. It does not mean anything. Whenever there's a big market move, they always come up with the reason that market move occurred. They never, ever have, I don't think in the history of mankind, have CNBC ever given the cause of a move before the move happened. Okay? It's always afterwards. So what I would do for now with this market, we're going to look at some techniques in a second, but don't start thinking it's going to be like this forever. Don't start thinking anybody knows when it's going to stop. Do start thinking it will just stop suddenly, and then a few weeks later you'll be almost forgetting about it and it'll be back to normal, right? But basically there's 3 approaches that you can take right now. First of all is you step down, right? So stepping down is basically the activity of moving to a market that is less volatile, right? So believe it or not, when you trade a market, you're not so much trading that particular market. Like if you like crude, or you like gold, or you like the euro, or you like the S&P, or you like the ultra bond, what you actually like about that market is the way it moves. And the way it moves is simply a function of the amount of liquidity and the amount of actual trade that goes through on that market. That's it. It's almost like a mathematical thing, right? So it's the amount of liquidity that determines how that market moves, right? So we have very illiquid markets like crude, and we have very liquid markets like the ultra bonds or the 10-year, right? Now, what happens when the markets all rise? So just in case that's not clear, this is in order of volatility, with the most volatile on the left and the least on the right, generally speaking, right? Now, if crude becomes really volatile, if the markets as a whole become more volatile and crude becomes too fast for you, step down to gold, right? Have a look at gold and see if gold is now moving more like crude than crude usually is. And if gold's too fast for you, step down to the 6C, step down to the bund. There's a whole bunch of markets with this sort of liquidity. And you can just step down to different markets based on liquidity. Now, I would say 6E and the ES, you could swap those around at the moment. But like for people trading the S&P, go to the treasuries and see if you can find a market in the treasuries that's got the volatility you're looking for. So basically, keep your technique the same, step down to a slower market, right? And there's a chance that your slower market is faster than it usually is anyway, and it's just giving you some kind of activity you're looking for, right? So right now, Eddie, we'll have a look at the different markets and we'll have a look at how we assess that. But basically, it's just experience more than anything else, and just watching them. But basically, it's the amount of depth on the book. And yeah, as Phil says, you watch how it moves on the dome. You can look at the daily ranges in number of ticks. Okay, so if you are now into order flow for the first time in your life and your desire is to trade the US indices, what I would say is one of the first things you should do is take a look at the treasuries. Just go and look at a different market, right? And then when the S&P slows down, go back to the S&P and you will find that experience in the treasuries will really help you with the S&P. Second thing you can do, step away, right? Now, obviously, if you're just learning, I don't believe you should step away if you're just learning. I believe you should get your hands dirty and keep learning. Trading is a perishable skill, and it's something you really need to do regularly, right? You can't stop trading, right? If you stop, you just kind of lose the edge, right? So stepping away is a good thing unless you're just learning. So, if you're just learning, you're going to lose the skills a lot easier than somebody who's been doing it for 10, 15 years. And then the other thing you can do is just get in later, And I did an article about this on the Jigsaw blog last week. But basically, you know, I've got people that have been trying to widen their stops. You know, it's more volatile. I need to widen the stop. What happens? They widen the stop. It still gets hit. So they're getting stopped out just as often, but it's now costing them more money. And so what I mean by getting later is you might have a setup now, and when that setup occurs, you get into trade and the setup moves 10 ticks, right? Now, when it becomes ultra volatile, that setup's still going to occur, right? It's going to be a lot more volatile around the setup area, but the setup's still going to occur. It's going to move 30 or 40 ticks. So what you can do is let the setup occur, wait for the market to move your way with some techniques we're going to see in a second, and then get in. And then ride that move. So instead of trying to just nail the setup to the exact location the setup occurs, trying to be so precise with the setup, realize that no setup will be precise anymore, that there's going to be a lot more wiggle around any setup, and wait for it to confirm. Because what you've got now, you've got a case where, you know, you always pay for ticks. You always pay for confirmation with ticks. Right? The more confirmation you get, the more the market has already moved. But if the market's moving 30 ticks instead of 10, you can afford to pay up. You can afford to pay for confirmation with a few more ticks and still get a bigger trade than you would have done 4 weeks ago. Okay? But for now, let's have a look at the market. So what I want to do first, let's just look at some of the other markets. Let's look at the bonds for a second, and then we'll look at Eurex, and then we'll actually look at some of the techniques you can use on the fast markets. 2 seconds. All right, so a file. All right, take that out there. Right, so everybody looked at the treasuries before. Right, we all know the treasuries. Right, so what we can see here, we've got a really fast S&P market, and we've got 3 markets here that are correlated, and we can see we've got 3 different levels of volatility. So we've got, 12, 15 ticks there, a nice little range there on the ultra bonds. And on the bonds, again, quite a small range. So if you were brand new to order flow, here's 3 markets that are correlated, that will give you a bit of move, that will give you a lot of time to make a decision. They're probably a bit faster right now than they normally are, but this is more the kind of market that you want to be watching. Now, these are a bit slow right now. The reason they're a bit slow right now is because we're coming into lunchtime, okay? But you can see now, if you were looking at the order flow for the first time and you decided to initially focus on the S&P is moving all over the place. Okay, let's flick back to the S&P. And there we go. So look at the S&P. Let's just clear that out. Sorry. Let's just watch this. Excuse me. Fingers are all over the place. Let's just watch this move around a bit. This is lunchtime, but let's just watch how this is wiggling around. It's actually gone to it's just actually slowed down a little bit right now, but let's just watch as it starts to kind of whip around. So even now with what this is doing now, this is difficult to read. There's no direction. We've got this bit of sideways movement here anyway over the past few seconds, but let's just watch this play out a little bit. So you see there, just boom, moved up 3 or 4 ticks. Right, let's just take that, clear that again. Okay, so the S&P tends not, when you trade in the S&P normally, it tends not to sweep like 5 to 6 ticks at a time. You know, somebody was asking, how do you tell how fast or how volatile a market's going to be? It's simply these numbers here, right? So these numbers here, usually 300 or 400. On the S&P, but also these numbers here, you see 37, 52, 57. That's how many contracts it's taking to eat through each level, right? Now that should normally is going to be like 100 plus on the S&P. Let's just go back to the treasuries, right? Very slow, and I did just clear that again. But look at the depth. Look at the amount of depth. The numbers here, 400, 400, 200. The numbers are much bigger, much bigger, right? Obviously on this market here, this is an ultra thick market. I wouldn't suggest you focus on something like that. But like, 200, 300, those kind of levels, that's a nice thick market to look at. If we just switch to Eurex, other markets we can look at the Bund. Bund's got a really good range. If you look at that range on the Bund, I think $10 a tick. Yeah, 15. We used to see 1,000, 1,500 contracts on the S&P historically. Now, if you look at the Bund here, we've got three markets here. We've got the Bobble, the Bund, and the Euro stocks. Now, the Euro stocks, this is quite a big range for Euro stocks. You can see on the Euro stocks a big set of numbers here, but this is actually quite volatile for the stocks. And again, it's that volatile because the US indices are going and there is that relationship there. But you can see the amount of liquidity there. This is not a market that's going to move up 3 or 4 prices in an instant, right? So the Bund, the Euro stocks, that's a decent daily range. So if I was looking to step down from the S&P right now, the Bund looks a really good bet. I mean, we're into lunchtime in the US. I'm hoping we can get some volatility on the S&P in a second. But we're into lunchtime on the ES, in the US, sorry. And so things are slowing down a bit. But those are the kind of markets you want to be looking at. Now, the Bund, when you get to the US Open, the Bund will still be quite active. You're going to need to get Eurex data feed because these are trading in Germany on Frankfurt. But it's worth doing at this period just to give yourself something to practice on. Okay, now let's see if we can get some volatility in the S&P. Right. So here's what we need to do for the S&P. So let's just go through the questions. Dow is typically 200 or 300 for 10 levels depth. Now it's less than 80. What's the difference between now and the summer? Okay. The thing about the summertime is that everybody disappears, right? So if we just look at the volume, see if I can get the close ninja. So if you look at the summertime, you're going to have days where the volume is like is as low as like 500,000 contracts. Days like this, the volume's like 3 million. So there's a massive amount of volume. There's a massive amount of trade going through, but the liquidity's gone. There's no market makers sitting there, willing to take the risk, right? So if you want to stick to the indices, right, which is fine to do, you're going to need 3 things, right? And the 3 things you're going to need depth of market for the S&P. And this is what I'm recommending. I don't recommend on the indices right now, I wouldn't recommend particularly trading the NASDAQ or the Dow. One of the reasons most people trade the NASDAQ and to some extent the Dow is for the volatility. And you've got plenty of volatility in the S&P. Trading the NASDAQ right now is so all over the place that it's really tough. Anyway, so let's just have a look at some techniques you can use, right? So on the S&P, first of all, right, keep up a depth and sales, keep up the dome, and we're going to watch the dome. And what we're looking for on the S&P is we're looking for pauses. So when it's whipping around wildly, it's just not a good time to get into a trade, right? So there's going to be times where it's just up, down, up, down, up, down. It's slow now because we're into lunchtime, but still it's still moving a fair amount, right? So you want the depth of market for the S&P, and then for the NASDAQ and the Dow, you want a really short-term chart, right? And the things that you're looking for right now, the kind of probably the thing that I think is the best edge in the S&P right now is 2 things. First of all is when all 3 markets take a breather, right? So what you'll see, I mean, we had it here, all 3 markets a little bit earlier on this period, everything went sideways. And we're going to wait till that happens again. The second thing we want to look for is when the market goes directional and just pulls up a little bit and seems to take a breather, right? So we're going to see one of those things first. We've got a directional market now. We want to see that market pull up a little bit, right? Okay, so it's pulled up. We've gone up to 57. You can see these two markets are moving sideways a little bit. We've just pulled up a little bit. And now what we're expecting is we're expecting the kind of move up to run out of steam. Okay, we don't want a big move on the NASDAQ or the Dow, but we've just got up to 27.50. Now this is something I want you to try and sim, right? So we got up there, we traded 7 at 57.75. We can still see the Dow and the NASDAQ are just moving up a little bit now. The NASDAQ's gone flat, Dow's gone flat. Let's just see if we can move up any more on the S&P. And what we can do now is we can just take a little tickle. And what we want to see, now I'm not going to be able to manage this and talk at the same time. What we want to see now is we want to see momentum break to the downside, right? So what we looked for is we saw that these markets were going sideways. We saw that the S&P pulled up a bit, and we saw that really the S&P didn't seem to have the power to really go up any further. And we also then saw these two markets starting to move down, right? Now that is a really good order flow trade for right now, right? It's just a nice little thing that's going to happen over and over and over again, right? We're going to be able to do that over and over and over again. Now, first of all, can I just ask, did you understand that? Did you understand what went on there? Because I can put it in Notepad. So what I'll do is as well, Notepad. Now, the other thing I've got to say is I've done that before, right? So I don't need to think that if it doesn't work for you first time, that, you know, it's not for you, or you're no good, or God, Pete's done it, you know, Peter G. I'm not. It's just something I've done before. Now, it's just watch. You see these markets moving up now, right? So what we want to see, let's go over the rules first. We want to see momentum one way in all three markets, right? Because we want continuation, right? So if you want continuation, you need it moving in one direction. Okay, so that's the first thing we want to see. The second thing we want to see is we want to see the market pull back a bit. Right. Now, this is where experience comes in. If it rips up, you don't have a continuation trade. Right? You just haven't got it. It's not there. So the first thing is, and I'd also say if NQYM rip up, you don't have a continuation trade then. Okay, so you see the market pulls back a bit, and then the pullback stalls. And the thing is, right, the thing is about this, you know, when I started then to say, oh, the pullback's kind of stopped, I didn't get in straight away. I just kind of let it play out a little bit, you know, and give it a little time to play out. And also, you know, the pullback stalls, you give it a little bit of time to play out. Make sure NQ, YM aren't moving up against you. You know, you really want NQ, YM stalled. And then 4, you can just some sign, some sign that, you know, either, as we said above, NQ, YM really stalled. If not, NQ, YM starting to push down. Now, does this make you right? This make you right every time? And the answer to that is absolutely not. Okay, so can somebody tell me, if it doesn't make you right all the time, what is it giving you? What did that give us? What did that give us? Do you know? I mean, I don't know if you realize, maybe you don't know, but have a guess. What did it give us? It didn't get, it's not the probability. It's kind of an edge, a little bit of an edge. Yeah, a little bit of an edge. It gave us an edge. Gave us an edge. But it gave us time, right? It gave us time. So one thing, you know, at that entry point, one thing that's unlikely is for everything to suddenly whip up and blow past our stop. Right, because the market's basically, it's given it basically, you've taken this whole market, it's going, whoa, 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 it's going up and down, and it's crazy, and you're just waiting for it to slow down a little bit. But you've already identified some momentum, you're waiting for it to slow down a little bit, and then you're just using that slowness and saying, well, because it slowed down a little bit, and it's starting to move my way, there's like that little edge to the downside, there's that little bit of downside momentum, but the real key is there, it's slowed down, so it's just not going to run against you. Right now, Andreas asking about using the RTY instead of the Dow. The Russell's been interesting, right? Since the Russell moved from ICE, it's really been slow. It's really been, I don't know, it's really been slow, and the correlations haven't been good. So for me, the Dow and the Nasdaq are absolutely the ones to use. Those are the ones to use. So anyway, that was the first setup. Now let's see if we can get everything running sideways. The second setup, and the stop on that was 4 ticks, Greg. Now, I'm not saying the 4 ticks is the stop you should use. It's just the one I got programmed in. So but basically what happens is, because you're watching all the 3 markets move down, or you're kind of getting that, right, then they're starting to tick down, you don't actually need a big stop, because you kind of trade into the momentum. Now, you might need a bigger stop when you first start doing it, but basically, your stop in this case is really like a mental stop, because if it just starts spiking up, you just get out, right? But it should do so slowly. Now, the second trade, if this will happen, it's a similar thing, but basically, again, you're waiting for the market to just go completely sideways, and then wait for a break. So with the trade we just did, it was really about, so now we're seeing these markets go sideways. Right now, I don't think there's a really good way to have a bias at the moment. Okay, so you can see there's just that little pop up on the NASDAQ. Okay, now it's popped down. Wait for the market to go, so, okay, now it's working down. So, okay, we don't have that sideways condition anymore. Let's just see if NASDAQ levels out. But basically, you can have the same kind of trade where you've got all this up and down momentum on the S&P, and you can just sit there and watching it go up and down, and you can keep getting in and out and keep getting stopped out. But every now and again, it will flatline, and it won't do it for long. It will all flatline, and then what you'll see is you'll be able to keep your eye on the Dow and the Nasdaq and just wait for the break, and just wait for them to break. It doesn't look like it wants to do it at the moment, but effectively it's the same technique. You're leaning on the Dow and the Nasdaq. The one technique was saying, okay, I've got clear momentum one way. I mean, if you look right now, there's no real, you can see the Nasdaq's edging down, the S&P is quite flat. There's no real direction now. So that first trade we did isn't really going to work out. So, if you've got the directional trade, take the directional trade. The other trade is wait for them all to just go sideways. And I'm hoping it's going to do that right now. So one of the problems with doing this live is that you can't rely on the market to give you what you want. So you can see the Dow is pretty flat. See the Nasdaq's pretty flat. What we want is for the market to kind of look like it's going to break one way. So ideally what you'd see is the Dow and the Nasdaq to start to break up without the S&P breaking up too much. Okay, so you see you've got that little break there. We didn't have an opportunity there because when those two broke, the S&P broke up. So the kind of break I'm looking at is not quite as extensive as this. It's like a slower break to the upside. Let's just see if it goes sideways and give us something again. So we're just looking for these two markets here to give us some indication that they're breaking or they're putting in a move before the S&P. Okay, so we might have something here to the upside again. Okay, so we can set a little bit break. Now, the thing about these trades, okay, so you see they're trying to break up. Let's just stay in that. Think about it is a bigger than a 4-tick stop. Think about these trades. If these markets break down, then you're out, right? So you can see we start to go sideways, so we can just exit. You see, look on here, the Nasdaq has broken down. That would be your cue to exit, right? So we wouldn't be in this trade anymore. So let's flatten that. Let's just see if we can actually get this thing going sideways a little bit. Okay, but you see the this chart here is a 1 second chart, right? Asking about that, but basically, do you get the overall idea, right? The markets are going sideways. You see the spike up. What you don't get in these cases is you don't get on the wrong side of one of those moves that sweeps through your 20 ticks, right? So we're just looking at the markets taking a breather, moving sideways, seeing the kind of more volatile markets start to break up a little bit, and just leaning on that fact that you've got two markets pulling upwards. Your market hasn't quite followed yet, and then you can get on board. But I don't think we're going to get those conditions at the moment. Let's just try one more. I keep feeling this is going to break up, to be honest. Okay, so we can see they're breaking down. Okay, so now we've got this kind of sideways action. See if we can get a lift. Okay, so you see there the Nasdaq and the S&P went, but the Dow didn't. I really want to see the Dow and the Nasdaq go and the S&P stay behind. That gives me the opportunity on the S&P. It gives me that kind of breathing room on the S&P. If you've got the other two markets lifting and the S&P hasn't moved yet, that's your breathing room. That's your opportunity, basically. So what I'm going to do is it's obviously not going to do that for us, and I don't want to kind of bore you by talking about something that's not happened. So what I'll do is I'll try and do a video of the other trade, and I'll put that on a blog post on the Jigsaw blog. Do we have any questions at this point? Like saying, the second setup is my normal day-to-day ES setup. Yeah, it is a pretty common setup. And the reason I'm showing it, Mark, is because it's one of the few things today that, it's one of the few things that you can look at today that actually, especially for new traders, that actually gives them a chance to react, right? And the entry was a market order. Yeah, I was off on the side with the trade window. So absolutely a market order at the moment. The idea of looking at two of the markets, I found the Dow and the Nasdaq really reliable. Nicey Tick I've used before, AD and Vol, and I wouldn't use too many market internals. I would stick to, you don't want to use too many things that you're looking at the same time. I will send out an email to this video. Yeah, I mean, basically, Lorenzo, the thing that I'm recommending here, it's not like an arbitrage trade. I wouldn't recommend an arbitrage trade because I don't know enough about it. What I'm looking at is just finding a sweet spot where it slows down, and then you start to leverage. So you're finding those slightly slower periods in the market that actually get you to be able to read it. And again, George, you could do full position on and taking pieces off. This really wasn't about trade strategy. It was about finding a place in the market where, especially as a new trader, you can actually find an edge in the order flow, as opposed to watching it whipping up and whipping down and thinking, what the hell's going on? So, it's going to whip up and down. It's going to whip up and down. And then suddenly it'll go into that sweet spot where there's an opportunity, and, you can get on board, and it can just come back and you get out. It can just come back on you. Okay, it didn't work that time. But overall, if you do it right, there's going to be times when you get on board and you get a run, right? So even if you're only like, even if you're getting like a 50% win rate on them, it's absolutely fine, because you're going to occasionally get on a run and you're just trying to find that place where you've got a decent chance of getting in without it immediately going against you. Because like at the end of the day, nobody knows if this is going up or down, right? There's nobody knows if this is going to be 26.30 or 26.70 in an hour's time. Nobody, right? So all you can do is just try and finesse an entry one way or the other, right? For high volatility, do I think it's better to focus on longer swing setups or more on scalping? It's kind of a it's difficult because everybody thinks of something different as scalping. For me, my typical scale out is every 4 ticks for 5 scale outs. So my typical trade in just regular markets will be 20 ticks. So I'd be looking to get a little bit more than that. So I'm just trying to get in on a runner. But, you know, this is a market that moves 100 points, 400 ticks in a day. So, you know, if I get 30 ticks in a trade sometimes because I'll get on a lucky runner, that's kind of peanuts compared to the overnight range. So it's not really a swing setup. So I think shorter term, just getting bites out the market is what I do. Somebody saying 6J has been a good market to watch with the ES, Dow and NASDAQ. That's good to know. It's another correlated market. Is there a role for power meters in this setup? No, there's enough things to look at. It's a really fast market, and you've got enough things to look at with those 3 because you're really trying to focus on all 3. Yeah, I used to get a run before the volatility went crazy. Yeah, the problem is we're staying in trades too long here. It can just come straight against you. Even if you've got 30 ticks on side, you can take all that back in a few minutes, right? So I would agree. Early afternoon, some opportunities outside the edge of the range. That's good to know, but it's past my bedtime, usually early afternoon. How do you turn on the histograms on the waiting bid and offer column? I don't know. That's a very good question. They're just always on for me. Appearance, bid and offer, ask depth. It's the ask depth histograms right here. Okay. All right, guys, with that, guys and girls, I should say, I would like to thank you for coming. I will put out a video. I'll actually do the video tonight and put it out tomorrow. So thanks for coming. I hoped it helped in some way, and especially for the new guys, you know, just wait for it to slow down. Look at a different market. You will learn just as much either way. And thanks for all the nice comments, and I will see you in the next group therapy.